During my travels last week, I spent some time in the Great Smoky Mountains. There weren't any bears there. And there's no bears left on Wall Street. 5,500. Right back up, folks. What did you do when I was gone? We'll see what happens this week, of course. We got some earnings, jobs data at the end of the week. But let's get things started on this Monday. Pre-market prep right now.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Okay, folks, let's go to the charts. We are back in the 5,500 handle. Traded down, but well off the lows of the session. Down only 9 handles at 55.41. The buck trying to steady here around par. Look at that, a bunch of highs at the 99.50 area. TLT, well, pulling back from Friday's rally, down 20 cents at 88.69. USO riding the ship last week, but down 32 cents today, 68.71. GLD pulling back from that historic rally, down 75 cents, 303.98. SLV flat, 30.04. And Bitcoin inching its way back up to 100K, flat this morning at 96,200. All right, let's bring in Triple D here, and Triple D, good to be back here. What did you do to the markets last week?
Well, let's not even worry. What did you do to the markets here last week here, Joel? Because normally you go away and the markets tank, but this was not the case. This was the curveball because the Joel Elconin indicator failed here because the markets did not tank when Joel went away. They rallied relentlessly when they went away. So one, first tell me about your trip, and then two, tell me why the market rallied when you left.
Well, first of all, eyeball indicator, no recession.
Ooh,
People are traveling.
they're doing stuff.
People are traveling. We hit several different cities driving back from Florida, and boom, boom, boom. Where a lot of people traveling, a lot of people on the road. Second, we have our favorite national park right now, Great Smoky Mountains. If you've never been there, you got to go. We've been to several. Lisa's been to several. Absolutely beautiful. Absolutely beautiful waterfalls, hikes. And then I'll give you the last highlight here. We ended up, our last stop was Louisville. And on Friday, we spent about 4 hours at Churchill Downs.
Awesome.
We had multiple tours. We got to see the Derby horses work out. And then we had a tour of the backside of the track. And while we were on that tour, there were several horses trading. And this guy rides by. And do you know what an outrider is in horse racing?
I have no idea.
Okay, yeah, you ever see like in the big races how they have a horse when they're warming up or going to the post parade, they have a horse right next to it?
Okay, what's that horse do?
Just to calm them down. Just to calm them down.
The horse like talking to the other horse.
Yes, yes.
You just stay calm. You know it's a big race, but you got this. The horse is just coaching him, eh?
Exactly. And also the
horse.
Also, the outrider is responsible that if a jockey gets dumped from his horse, the outrider is responsible to go lasso the horse, because that's a very dangerous thing. When a horse is running without a jockey in a race, well, the guy that we met was the outrider in the 2022 Derby. And in that Derby, a long shot won it named Rich Strike. And I don't know if you all remember, but there was a picture of the outrider punching the winning horse in the mouth. And you know why he did that?
No idea.
Because he took a chunk out of his leg. The horse that won the Derby, when he was bringing to the winner's circle, clamped on the guy's leg and was Oh, yes. Yes.
Really?
Yes.
So
Yeah. And
sometimes
so
these horses aren't that friendly.
oh no. And so the outrider bam, punched him, and then that horse,
Wow.
Rich Strike, bit his horse. Bit his horse. And he had to calm him down. He had to calm him down. So
Holy, crazy
how's that for a
stuff.
story about the
This is
Derby?
a Monday morning story to wake you up here. Horse bites and horse calming. And Joel, I'm glad you had an awesome trip though. He sent me pictures obviously on the way. It was wild week with you were gone though.
Yeah, I
Because
mean, why do
wasn't
we
so
rally?
wild for the
Why
Bears,
why
but
do
it
we
was very
rally?
wild for the Bulls.
Yeah,
It's
I
just
I
it started the week started with what we were saying. I think it was Monday or Tuesday. I'm losing track of days from last week, but with Trump basically coming out, Besant, Latnick coming out, and obviously over the weekend they had talked and they had said, "Look, this market can't keep tanking," and they must have had like talking points or something because it came out on the Tuesday and Trump said everything the market wanted to hear. One, not firing Jay Powell. He said, I was never firing Jay Powell, and that is fake news. So the market ripped higher on those comments. I mean, like it was after hours on like I think the Monday night, and it was just a rip roar and rip your face off rally for the shorts. He also said the China tariffs are going to be way lower than where they currently are. So market loves that too. And then he continued to like just talk about, everything the market wanted to hear, with tariffs, and we're going to have 100 deals and it's going to be great for US and everything. So just literally talking up the market so much. We have not looked back since that commentary, and we tacked on about 120 S&P points on those comments. We've tacked on about another 120 points since then. So that's the TSN turning point. If you're in Canada, you know what I'm talking about. That was the turning point, and that is why I said on Wednesday, I believe it was last week, losing track of days again, but I said I believe the low for the year is in. So I made a bold statement. Obviously, the Bears don't want to hear that stuff, but everything right now, and again, we don't know. Maybe there's going to be, escalations happening here again. Maybe Trump's going to go. Maybe Xi's going to say something. We don't know what catastrophe lies ahead. But with the information we currently have, I think the worst of the tariffs is actually right now behind us.
just from afar, it seems like the market just wants to focus on good tariff news.
It
Yep.
is this change of sentiment where the market is now saying, look, we're going to get these tariffs kicked back in here. And like, remember, we did the 90-day delay. So when they do eventually come back in, and all those other, countries or whatever with all those extra tariffs, it's going to be probably a lot less than the proposal. So the market is now saying that, hey, these, thoughts of like, 60, 70, 80% tariffs, 140 or whatever is on China, it's going to end up being a lot less than that. And that's why the market is a lot more comfortable. But, there is, and we've talked about this too. This is why I didn't want to be short. This is why I didn't want to be bearish. We talked about this not last week, but the week before. I said, there's probably deals coming and they're going to be talking about deals and the market's going to spike on those deals. But we haven't even really got any deals yet. We haven't gotten official deals. We've got talks of deals and obviously countries coming close to doing deals, but we haven't even got that positive catalyst there either. And then the earnings from last week would start with Tesla here because this was an epic disaster. The earnings report for Tesla, just a disaster. The stock, the sales were terrible, everything, and it just didn't want to go down, Joel. It just couldn't go down. And we talked about that setup in the STN room too. And I said any dip probably gets bought because they've already priced in the disaster earnings. It hardly even dipped. And then the next day, it kind of just hung out. And then, as soon as the market starts to turn higher, Tesla just rips higher. So there you go. I'm currently long Tesla on my trading account, full disclosure. I sold some this morning. Just it's as an overnight trade. But I mean, we're just in this situation here now, to your point, Joel, where they're buying stocks even on bad news.
But
So
Dennis, folks
I
are
don't
here
know,
for
like, again,
this
things
week.
can change, but we've come a
Yeah.
long ways.
Yep. Folks are here for this week. We need to talk about this week. We need to talk about the catalyst for the market moving forward.
For sure.
But I guess to stay on the earnings thing, let's just get
That
the
is the catalyst this week. So this is a good segue into earnings.
yep. And I guess Domino's Pizza does not deliver.
So, okay, before we go to Domino's Pizza, I just want to set up this earnings week. So, in the STN room, I've, obviously been talking about, I think the bottom's in. So, I've started doing all of my normal strategies again, meaning I'm buying stocks ahead of earnings reports. Not Domino's Pizza. We're going to get that one in a second. But I'm buying so this was my list that I put out in the STN room that, the stocks that I was buying on the close. PayPal, it's green. SoFi, it's green. This is the day the market's down, folks. It's up 1.48%. Spotify, it's up 1.33%. Snapchat, it was up 2.5% last night. I sold it when it was up that on Robinhood /IB. It's green too. I had BYON, smaller company, still in that one. It's flat. I had Wolfspeed, it's green, WOLF. Wingstop is kind of flat. Etsy, I actually was able to sneak out of some of that on IB up last night as well. XYZ, I'm reading this right from the STN room. XYZ, it's green, just went flat just now, but has been green. Roku, I'm still in. It's kind of just hanging out flat. Peloton, bought Peloton on the close. It's up 5.56% because it got an upgrade, so that was just a gift. And then I had this little bullfrog AI trade. But, so I went 1, 2, 3, and Tesla as well. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I'm up on 10 of 13. The other 3 I'm flat on. And I hedged that with short SPY Qs, and that's working out too. So what I was saying is, it's funny, is some mornings you come in and nothing is working out. Everything's just working against you. And I said, this is not that morning. I'm like, holy, especially when I get a gift Peloton upgrade too, and it's trading up like that. So, and then I took one other trade in the STN room, Domino's Pizza. And I said, Domino's Pizza, all these earnings I bought, buying these stocks ahead of these reports, not intending to take them through, but just saying they lift ahead of the reports. But I had this one, I was like, you know what? Domino's Pizza is sitting up near 52-week highs. And Jay Rice, you called this. You've got me thinking about it. I'm like, I'm shorting stocks that are going in earnings, trading up near 52-week highs because UNH last week tanks on earnings. We saw multiple other examples. Jay Rice will remember them. I forget them. But there was 3-4 examples of stocks trading up near 52-week highs, reporting sometimes disappointing earnings, but sometimes okay earnings and still going down. So it's like the stocks that are trading near 52-week lows are reporting and rallying on bad earnings. The stocks that are trading up near 52-week highs are selling off sometimes on good earnings. So I was like, Domino's Pizza sets up like the one that's going to go probably down even if they beat. So it was trading up $5, and I was like, so I went short, took it through the report, and I've covered this one. I just covered it at 476, so I ended up making 16 points on it. But I mean, so even that trade worked out. So this is just one of those mornings for me in my own personal trading where everything worked out. So let's go to the Domino's Pizza report because that's where we're going to go out before I went on the big segue here. But Domino's Pizza did report earnings, 433 versus 407. That's a nice beat on the bottom line. 1.11 billion versus 1.13 billion. That's a little shy on the top line. But Domino's Pizza is not the stock they're looking for right now. If you're trying to risk on again, are you buying stocks near 52-week highs? DPZ is it's a more defensive stock. Like, it's not a tariff stock. Tariffs aren't going to impact Domino's Pizza nearly as much as a lot of other companies. So it's a company stock kind of been hiding. And like consumer staples didn't have a great week. They were starting to sell off because, again, once you're risking on, the risk off stocks come off. So you've got to have that in your head too. So it's all about like putting all the pieces of the puzzle together. That's what we try to do in the STN room. That's what we're trying to do for you here on PreMarket Prep, is just put the pieces of the puzzle together and then come up, with trades out of that, actionable ideas. There was a lot of actionable ideas, and a lot of them are working out here today. So Domino's Pizza, I have covered the short, but was able to get short. So happy about that one too. Oilers won 2 games on the weekend. It's just a morning that everything worked out. Tomorrow, probably nothing will work out. That's how it works.
Except the end of the Pistons game, but we will not talk about that. Very bad call at the end of the Pistons game.
What is that series at now? What is that series at now, Joel?
3-1. 3-1.
It's tough.
Yeah.
That's the first time they've been in the playoffs, though, for how many years?
I think since 2018.
Yeah, so you got like 6-7 years here. It's always your first time back to the playoffs. It's like a different style of game, and you can't expect much. So it's just nice that they're back in. It's nice that they're in the mix here again. team is better. It's nice to see that. But not a sports show, so we're not going to go too long on sports.
Yeah. Oh, yeah. Let's not talk too much sports. Okay.
Yeah.
So buying
Uh,
the earnings. Okay. So tonight's not a lot on the plate. We have two stocks, NXPI.
yes.
So that's kind of, well, it's definitely not at a 52-week high. It's definitely not at a 52-week low. This one looks a little bit more like a curveball.
Mm-hmm.
But I would just say, because there's no overnight trade in it because the earnings are tonight. I don't know. It looks like you got to. I keep an eye on 194.50. There's a pair of highs from the last two sessions. Also, the highs for the week in NXPI. Dennis, also FFIV. Let's see
Let's
where
stay.
that's true.
Yeah. Okay, we can preview them both together. Sure. I had FFIV on my list too, but I think same thing, Joel. Same chart. So sometimes you
Yeah, it
have
is.
clean setups. Sometimes you have clean setups going into earnings, and sometimes you have sloppy setups going into earnings. The sloppy ones, don't trade those ones. If they're sloppy, why trade them? NXPI is sloppy, meaning it's not at the 52-week high, like you said. It's not at the 52-week low. It's kind of right in the middle. I see some resistance at 200. I mean, the earnings report is likely going to matter here. It's likely going to be a case of like, if they're good earnings, it could rally. If they're bad earnings, it could go down. I like the setups where when they're sitting at 52-week highs, if they're good earnings, it's going to struggle to go higher. And if they're bad earnings, they're really going to go down. Or if they're sitting at 52-week lows like a la Tesla, that if they're good earnings, they're probably going to go up a lot. If it's bad earnings, the dip's probably going to get bought anyways. I like that setup. On the other side, this NXPI and this FFIV, they're right in the middle. I don't have a clean setup there, so why even bother trade them? Because there's 1,000 companies reporting this week. So, I mean, we can just look at other setups that are a lot cleaner.
Also, you said the charts were the same. Well, I mentioned a pair of highs, also the highs from last week, Thursday and Friday. Stock in this 270 area, you're down 78 cents. Also, you're running into the 50-day moving average. So keep an eye, 270 in FFIV. And then moving on, things start to pick up tomorrow on the earnings front. We definitely got some
Yep.
bigger names reporting. Boy, let's start with your favorite company, Dennis, Starbucks.
Starbucks. Joel. Okay, I'm taking the lead from you. You've been off for a little bit. So Starbucks is not a stock that I'm interested in trading here at all. So I did say I've traded and was actively long about 5 or 6 of these companies here that are due to report on Tuesday. So, like a Spotify, SoFi. Right now, my focus, so as a trader, is back, retail is alive again. Retail is hot. Retail's like, oh, we're going to make so much money in the second half of this year. Yeah, it was a bad first quarter. And yeah, I'm down 35%, on my stocks, but we're going to make so much money. We're so back. That's what they're talking about on Twitter. We're so back. So if I'm going to go into stocks right now, I'm not even caring about Starbucks because there's no retail trader that's interested in Starbucks. They want the sexy stories here again. Think about like the Spotify is a sexy story. The SoFi is a sexy retail name. SMCI, which is one I believe reports on Tuesday. I didn't have that verified yet, but somebody said it reported. It wasn't on my initial list, and they're like, oh, reports Tuesday. Maybe Chat can help me with that. But I mean, I'm into more retail darlings here now. You almost need like a retail darling list. And I'll tell you, there'll be 500 companies on it. 500, not 5, not 10, 500. So that's what we need to be focusing on, is those stocks that are real retail darlings that maybe haven't rallied that much yet, and maybe those could lift up. And I'm not saying we're just going to continue it. So going back, we're going to tangent here. It's going to be tangent Monday, not tangent Tuesday. But you look at SPY, we've come a long way. So I'm not, I understand. We came from 510 to 550. We had an 8% rally next week. So I'm not saying you got to come in here and just start lifting offers and everything's just going straight up. But I think we got to have the buy the dip hat on. So when we get dips, we're ready to strike on retail darlings. That's my strategy. So think about this. Buying dips, because I believe the bottom is in, on retail stocks that are likely to lift faster than other ones. More names that like talked about in the social community. So nobody's talking about Starbucks. I'm not even looking at Starbucks. People are always talk about SoFi, and it reports here. So I want to start with that one on Tuesday. It reports here. I don't know if it's Tuesday morning or Tuesday night. Brent can maybe verify that. But SoFi, SOFI, 1310, trading up 1.79%. So you got a day that the market is down. The stock doesn't even want to go down on a day that the market's down. Those are the kind of stocks you want ahead of the reports, those stocks that are moving up.
Yeah, this one it's moving up. It is a retail darling. Just going back to historical references, it usually has the beat and the pop, and then a lot of times it fades. It has some really big moves. I think even going back to the last couple earnings reports, I think you may see that similar price action. Really nothing up here between 13. If you could get above yesterday's high, 1305, you're trading above that. Hold 13. If you're looking for a short-term target today, 1355, and then 13. I guess in the report too, we'll just take it up to 14. So that one, it is a retail darling. It's kind of in the middle of nowhere, but it's a lower price stock, heavily traded, heavily followed. So I see your rationale on this one, Dennis. The Spotify, now that one not only is it close to a 52-week high, it's closer to an all-time high. But you're weighing the retail effect, the darling effect on this one is overruling it being. I mean, will your psychology change after the report? Let's say it has a big
Maybe.
beat. Yep. Okay.
Yeah. It can always change. So these setups, when I'm talking about these trades and these trades I'm taking the STN room, this is not like Domino's Pizza. I intentionally took it through the report. I put it on Friday night, taking it through, thought the bar is high enough that even if they really beat, the stock might go down, and they did. But I'm not saying, oh, I want to buy Spotify and take it through the report. I'm saying I want to be long and ahead of the report. So the money's been made. I mean, it's up another $9. It's telling you, look at this. It's up $8. The market's down today. It's up $8. Those are the stocks you want to be in. Those are the stocks you identify. I mean, that's a huge edge. If you could go in and the market could be down, you could pick all the stocks that are going to be up. I mean, what an edge. What an edge. That's just huge. Everybody makes more money when the market's going down or up. If the market's up and they're all long, you make money. But when the market's going down, your longs are up, that's, you pick the right stocks. So, I mean, just these core strategies of being long stocks ahead of reports. I know I sound like a broken record here, and people are like, oh, Dennis talks the same stuff all the time. You know why I talk the same stuff all the time? You know why? Because I'm making money with it. And I'm going to continue to talk the same stuff if it continues to make me money. I'll change the story, and I'll obviously, move on when I'm starting to lose in those strategies. And I have been shelving that earnings strategy. I have shelved a lot of that earnings strategy. And
Couple
in the SDN room, I've been saying it for weeks. They're people are bored, Dennis, why aren't you making any trades on these why aren't you doing these? I'm like, because the market's going straight down and I just don't want to lose money on these longs here right now. I don't want to be long, stocks like SoFi when the S&P futures are tanking 3% here overnight. You do not want to be there. But we're not in Kansas anymore here. We're back to a little bit normalized markets. Now, again, that can all change. One headline may change it here again. So markets are dynamic. Dennis Dick's trading is dynamic too. You know what? You have to continue to adjust to your market environment. But I've put all those strategies back on, where I'm buying stocks ahead of reports. So again, what I'm looking for this week is those stocks that are really talked about in the media. The Mag 7's always talked about. They're always talked about. But when you start getting close to earnings, what's getting talked about? Well, people get excited about some of the smaller ones, some of the mid-cap names. Like this week, so for instance, and we'll just go through a few names right now quickly.
Hey, Dennis, I just want to say one thing about the Spotify.
Yeah.
You know what else it has going for it?
Yeah.
Tariffs.
What?
Tariff-proof.
Yeah, so I have a list. Tariff-resilient stocks. Now, I'm going to throw you another curveball here, though, Joel. I don't want to own tariff-proof stocks right now because right now they're not worried about tariffs. So the tariff-proof stock trade is kind of over already. It was Netflix, and we talked about Spotify as well last week when we were worrying about tariffs. In the STN room again, I know I keep referencing the STN room, but that's where I'm talking about this stuff. So that's where I'm saying. I said when Netflix was $9.50, I said, I think Netflix, I said it, Joel. I think Netflix is going to be the first Mag 7
I know.
New all-time highs because it's tariff-proof. Boom. 10 days later, new all-time highs. It's not rocket science. It's just thinking. So it's not the chart. I know the Netflix chart looks so nice. Relative strength is great, sure. But I mean, there's thought process behind this. Why is it up here? Because, we're worried the hell about tariffs. Netflix is not impacted very much by tariffs. You could maybe try to reach a story and say, oh, well, the international investor will cancel the Netflix because a U.S. company, they don't want to support. That's all hogwash. Its tariffs are like, minimal impacts and pretty much none. Spotify, similar story. Tariff-free. So Spotify, Netflix, group those two together. Netflix is having a day. Spotify is probably having a day. So those are two that I would group together. I also put Roblox on that list, RBLX. It's been moving up. I put the video game makers, TTWO. TTWO new 52-week highs. Why? Well, that's pretty tariff-proof. Take two. So, the list is there. But again, the market's not worrying about tariffs right now. We'll go back to that list. Don't worry. That list is going to make us money here again, but that isn't the list for today. We're not worrying about tariffs right now. When we start worrying about tariffs again, then we'll start going back to that tariff-free list. But awesome.
Okay. Should we let's see. Let's just do we got the rest cover the rest of the earnings stocks for the week? We got most of them from Tuesday.
Wednesday,
Later.
Thursday is the heart. The heart.
Oh, all right. Do you wanna save those for tomorrow's show and move on to a new topic? What
No, we're
about
going to go into
GM?
them right now.
Okay.
So
What?
I'm going to take, that's Tuesday's earnings. I'm going to lead the way here, Joel. Wednesday,
Okay.
Microsoft, Meta, Qualcomm, Caterpillar, Humana, Robinhood, Hood, retail darling of all darlings. They love Robinhood and retail. Other ones are small. Wingstop's in there, Etsy's in there. I have Etsy. Thursday is the heartbeat of earnings season with Apple and Amazon. So in 2 days, we're going to get Microsoft, Meta, Apple, Amazon. That's going to matter to everything. And that could change the narrative, folks. That could be like, oh man, we've rallied quite a ways here and these earnings really aren't that great. That could change the narrative. I'm not saying it's gonna, but it has the potential to do it. So you're always ready to change your narrative. That's why I always say, if you listen to Pre-Market Prep, you got to listen every day. You got to keep coming back here and listening, because what I say today may not be how I'm trading 2 days from now, because I continuously, the awesome thing about markets is you continue to get in new information, meaning it's always giving you more information coming from earnings reports, more information coming from the Fed, more information coming from the White House, more information coming internationally. It's always coming in, and you always have to be changing the picture and adjusting. And that'll tell you what trades to make. Some people say it all shows up in the charts. I'll say the past all shows up in the charts. The future is made up of predicting headlines, earnings, everything that's coming. The future is, technicals are one piece of it, and charts tell you a lot, but it's one piece. So you got to be taking in all the pieces, paint your picture. That will tell you what to do. So what we know for this week is there's question marks surrounding earnings. That's all earnings. And what they've been doing, when you were away last week, I know, and you saw it the week before, is companies are hesitant on the guidance. They don't know what to do. They don't know how tariffs are going to impact their companies. We know Netflix is fine, but what's Apple going to say about tariffs? Everybody's going to be watching what Apple says about tariffs, because they are maybe the most impacted from it. What are they saying? Are they giving range on the guidance? Are they giving scenarios? Are they comfortable to guide? Are they saying we're going to be okay no matter what? Here's our plan. Are we moving production? All those questions need answers, Joel. And that's why we've got to come in, with an open mind. You can't come in and say, oh yeah, it's bullish. Bulls are back. We're going all-time highs. Just come in with an open mind and be receptive to new information, and then make your trades.
I think Apple is the one that's going to have the toughest time with guidance.
It really is.
Yeah. Yep.
I don't even know what I think it's going to be scenario analysis, saying tariffs, no tariffs, or potentially this is and we saw a couple of these do this, where if tariffs are in, this is the low end. And if tariffs aren't in, this is where we would end up being. So it's just scenario analysis, I think, is what it's going to be. And the market has been accepting to that. The market's been accepting to the scenario analysis. So that's a bad news for the bears. I mean, if the market starts becoming accepting towards companies potentially guiding down, that's the worst news for the bears. That's the news you absolutely don't want to hear. But things can change suddenly. Narratives can change. One comment from the White House could harpoon the whole market. So things can change. So you just have to be careful. People want to say, do I buy or sell? Do I buy or sell? Well, we're not investment advisors, so we can't tell you to buy or sell. What I can tell you is what I'm doing, and I'm staying open-minded. And right now I have my buy the dip hat on.
You're asking me, about, what was the narrative and from the tariff talks and everything. And I think one headline I did see was from Ken Griffin, and he talked about, like the whole notion with these tariffs about bringing back manufacturing, right? Making the United States the manufacturing hub. And I think that that's the thing for something like Apple is like the biggest, poses the biggest problem. So maybe the White House is listening to some of these smarter investors and stuff and saying, hey, you know what? We could do stuff with tariffs and stuff, but the fact that, we're going to bring all this manufacturing back in 6 weeks and change everything, it's just it's just not going to happen.
The fairy tale. It's a fairy tale,
Yep,
is what it is.
yep, yep. They
So,
can move
and
it to other
I think the
places. Not going to
administration
move
is
it here.
starting to realize, that hey, yeah, we can bring in some tariffs. We can start to try to push, to obviously, more American. And I get that. But you can't blow everything up. You can't blow up the, global supply chain overnight. And that's what was in essence happening until Trump did the 90-day kick down the road. I mean, the whole start of the rally, the whole start of this rally, like D-Day for the Bears, was when Trump kicked the can down the road 90 days. It's like, oh, he backed down. Some people were saying the art of the cave, they were calling it, all this stuff's, all over the memes we've saw, but it's true. He backed down. Now, does he get, if the market starts getting up near highs again, does he start talking tougher? I think so. So you have to consider that too. As the market starts to come back, it starts to become harder. Like, I'm not in the camp that we're just going back to all-time highs here either. It's been a good rally. I'm trying to pick up some laggards, trying to pick up some stuff that, has been bouncing back, trying to extract some alpha from a market that probably has 560 SPY. We get a deal, India, they're talking different deals, maybe 565, but I'm not thinking about all-time highs at all here yet. I'm not thinking we're coming right back here because, one, there's just a lot of uncertainty, and the market does not like uncertainty. So we can't just come in here, rah, bull, we're going back to all-time highs. We might. It's not out of the question anymore, but I don't think that's happening soon. So I think it's more of like, don't chase, same 2025 script. What's worked, don't chase. Sell the rips worked well. Buy the dips worked well, obviously in certain, not for 3 days in April, but for the most part it has. So I think I would just stay with that script where I'm not chasing.
Okay, S&Ps are almost flat here after being down, 30 handles here. We're coming back to scratch. We'll see if we can get the old follow through the previous week's high and keep on going. Not a lot of resistance here if we could get going towards 5,600. But we're gonna go to our guests right now, and we're gonna bring you guys a new guest and a good one. All right, Mike Singleton, CFA Senior Analyst, Invictus Research. Mike, how you doing today?
Good, Joel. Thanks for having me.
So he did go to Notre Dame, but that's okay. It's okay that he went to Notre Dame. So, Mike, you got a new company here, a relatively new company, Invictus Research. Why don't you tell us about it?
Sure. So I've been the Chief Investment Officer, if you will, at Invictus Research since 2021. We're a boutique provider of macroeconomic and market strategy research. So what we spend most of our time doing is analyzing what the economy is doing right now, where it's likely to go, and how financial markets are likely to react. That's stocks, bonds, commodities, and currencies, but with a focus on stocks. And the gimmick, if you will, with our business is that our flagship products are all delivered over video. So instead of getting another long, boring PowerPoint slide spammed out by a salesman in your inbox at 8 a.m. every morning, we give you a short 5 to 10 minute video. We cover all the most important economic data, most important market moves from the day prior, and we put it in the context of the business cycle, sort of complete with back testing. Hopefully it's very easy to understand, very digestible, and just a better way to consume research than conventional Wall Street research.
Who's your target audience?
So about half of our business is financial advisors, and the other half is sort of mass affluent retail investors, hobbyists, and we have a few hedge funds mixed in there, but those are our primary demographics.
All right, so you're here to answer all the tough questions. from
I'll do
your
my best.
research, right?
That's right. Yeah.
Okay. Are we in a recession right now? The U.S.
So I think the answer is that we're not in a recession right now. When you look at the coincident economic data, it's still very strong, right? The most recent Redbook weekly sales data from last week was about 7.5%. The weekly economic index, which is a great composite of 10 different high frequency measures of real economic growth, came in at 2.7% last week. Not only is that not recessionary, but it's 100 basis points plus above long-term potential real growth in the U.S. The bigger and more important question is, are we headed for a recession? And I think it's too early to tell. I think that the odds of us headed for a growth slowdown are relatively high. And I think the reasons for that are somewhat obvious: tariffs, policy uncertainty, freezing up investment. It's just a question of whether that uncertainty will metastasize into something broader and more important, like a recession. And probably for now, our base case is no, but this is an uncertain environment where things can change quickly. So it's never been more important to sort of stay on top of the data and what's going on.
All right. So obviously a key component to whether or not we go into the recession is what happens with tariffs. And we don't really know what they are right now. But give us a couple possible scenarios of how tariffs could affect growth and also impact on inflation.
So it's a good question, and it's actually very hard to model because there is a lot of uncertainty about how tariffs will actually flow through the economy in terms of how much of the tariff gets financed by the foreign producer, how much gets paid for by the consumer, like a consumption tax, how much is offset by currencies. But our work at Invictus suggests that tariffs, if they're implemented as they're described now, which is obviously a pretty big if, there'll be about 100 basis point drag on real growth over the period of implementation. So if real growth was going to grow at 2.5%, with the tariffs, call it 1.5% or 1%, right? Inflation, expect the impact on inflation to be relatively small with no policy offsets. But to the extent it does impact prices, it'll probably be a slight tailwind for inflation, so slightly higher inflation. And we expect the overall impact on nominal GDP growth to be de minimis probably, but maybe slightly a headwind to nominal growth, right? If there's no policy offset, it more or less acts like a tax, right? So all else equal, if you raise consumption taxes, it would be slower real growth and probably similar inflation. So I think that there's a good chance that's the way tariffs pan out as well. The bigger question.
So if we just get rid of all the tariffs, then we're off to the races, right? We avoid recession. We're going to 5% GDP. Is that what we need? We just need Trump to, yep, no tariffs. I changed my mind.
So by our work at Invictus, you always have to ask, what is the market priced in now and what's likely to happen, right? And so what the market is essentially priced in now is real growth from about, call it 2.5% right now to about 1% through year end. So it's priced in a relatively severe contraction in real growth. Obviously, if the tariffs are lighter than expected and real growth comes in above 1%, that gives you kind of upside relief in the stock market. And if it comes in lower, that's where you would see further downside in the stock market. So in our view, in order to see a decline in real growth below just 1%, really what you need to see in terms of the economic fundamentals are layoffs. That's how you would get sub 1% real GDP growth over the next year, we think. The question is, are layoffs likely? And I think that's too early to have visibility into that, right? But layoffs are kind of the defining ingredient of any recession. So that's data that we really want to track closely. We want to track hiring intentions data. We want to track the initial claims data is really, really important. And we want to see how the cadence of that data develops over time. I'll stay on sort of a positive note that if we don't get layoffs, non-recessionary growth slowdowns are sort of the fertilizer for the next leg of a bull market. So if we don't see layoffs, that would be, a very good sign in terms of the duration we could expect out of the current business cycle. But again, we kind of have to watch for the incoming data.
The Atlanta Fed predicts GDP of negative 2.2%. Any comments on that?
I think the Atlanta Fed data is probably not the most reliable for Q1. It's got the gold imports issue, but even when you adjust for the gold imports calculation, it still doesn't look quite right. The New York Fed's real GDP nowcast for Q1 is running at 2.6%. We just cited the weekly economic index a minute ago. That's a composite of 10 different indicators that are very hard to fudge. So it's rail car traffic, steel production, electricity output, jobless claims, and that's running at about 2.7% per the last reading. Again, very hard to fudge. GDP is kind of an accounting contrivance. Rail car traffic is not. So you look at the discrepancy in those data points, you see multiple data points showing around 2.5% growth, and then you see the Atlanta Fed showing negative growth. We're inclined to think the Atlanta Fed has some sort of accounting issue that will need to be resolved. We take it seriously and we obviously watch it. But we think the Q1 data is going to be fine. There were no tariffs in Q1. Maybe there's going to be an issue with exports that sort of drags on the headline GDP growth figure. But if we look past that, it's sort of the core real growth, maybe something like real final sales of private domestic purchasers. We have a very hard time imagining that comes in below, call it 2.5% in Q1, or say maybe we'll be more liberal and say below 2%.
I know what we need to do. We need to get rid of Jerome Powell, and we need to lower interest rates immediately.
So I think the odds of that are pretty low. We've done a little bit of work on some of the logistics that in terms of laying off Chair Powell and how long that would take. And by our work, it would probably take about 2 years inclusive of the appeals process. And he only has about a year left in his term. So I think that the idea that President Trump would lay off Chair Powell is very unlikely. It's sort of all risk for markets and no reward for President Trump. He's also said at this point that he's not going to do it. So I would take him at his word on that. On lower interest, would lower interest rates help stimulate the U.S. economy? All else equal, lower rates always help stimulate the U.S. economy. That doesn't mean it's enough to offset whatever policy problems or fundamental issues are going on. But all else equal, lower rates are always a good thing. It's kind of like fiscal stimulus. All else equal, it always tends to help stocks. It always tends to help short-term measures of real growth. Again, it doesn't mean it's enough to offset the countervailing headwinds, but it's usually a good thing.
All right, so taking all the information that you gathered, fundamental analysis, I don't know how much you pay attention to technicals. When we spoke on the phone a couple weeks ago, I think the market was a little bit lower than here. We've rallied back up. I guess we could call this the post-tariff tantrum highs, if you want to call where the market is right now. Quite a distance off the all-time high. Quite a distance off the recent low and perhaps the low for the year. I would think it's going to chop us to death and for the next 90 days until we get more clarity on what the tariffs are, or do you got an inkling of which way we're going back up 5,600, 5,700, 5,800, or you think we're going to maybe grind our way back down but not get to the lows of the move?
So it's a great question, and I'll give you two answers because we have sort of a fundamental based answer and a more technical based answer. On a fundamental basis, the house view is that the markets have probably overpriced in this decline in growth. They've gone a little too far, relative to where we see economic conditions developing over the next few months. So we think the stock market probably trades higher. Here's the technical view. The technicals are a mess, right? All of the major stock indexes have broken trend. In other words, they're below declining 200-day moving averages at this point. Credit spreads are rising. Market internals are a mess. In other words, leadership within the stock market is now skewing defensive. And we've done a bunch of back tests on this. And historically, when that's the case, forward returns for stocks are well below average, right? So over the short term, we think the stock market, the S&P 500 can climb to call it 5,700 just based on sort of flushing out the really, really shelled out positioning and sentiment data. But at 5,700, we would be reducing exposure very aggressively. I mean, even as we approach 5,700. On top of that, I would add, even if our base case is right that we don't go into a recession, even if we just see positive growth but declining in rate of change terms, average returns for the S&P 500 are not that good in that environment. They're called 2 to 5% on average. Which is just maybe another way of saying chop, right? So even sort of our bull case is chop from here, and our bear case is, a recession. So again, reducing net as we approach 5,700 is how we think about it.
Okay, so we're in the U.S. We're U.S. centric. We've seen, some of the foreign markets rally. China up and down, Europe up. gold, silver. I guess it's part of the U.S. markets, part of global markets. Um, is it come a time, which hasn't been for a long time, to start looking other places to put your money besides the U.S. markets?
So I think the answer to that is probably yes. I'll say that foreign stock markets aren't terribly interesting. We've been bullish China. We're still bullish China. But I think the idea that if there's a global recession, China is going to outperform the U.S., or that emerging markets more broadly are going to outperform the U.S., or even that European stocks are going to outperform the U.S. We just don't really buy that. So I think if you're going to short stocks, or you have a bearish outlook on U.S. equities, it probably doesn't make a ton of sense to take a bunch of beta risk in other foreign markets. Maybe if you did it like a pair trade, we don't have a view on that, but maybe that would be a more responsible way of playing that. Outside of stocks, we can just ask the question. Earlier we said our technical outlook is bearish because stocks have broken trend, credit spreads are rising, market internal leadership is defensive. So historically, in environments like that, what are the assets that perform best? And the answer is, historically, it's been duration. In other words, long-term government bonds like the 10-year note, and it's been gold. So those would be the areas that we're looking to add exposure. Now I'll say gold looks great technically, right? It's in a strong uptrend. It's probably overbought, to be honest, but that's where we'd be looking to buy the dip. The 10-year note, technically it's a mess. The 10-year yield is very choppy, very messy. It's got a decent yield on it, so we don't hate that. If you put a gun to our head, we'd say the 10-year note probably, outperform stocks over the next 6 months, but it's still technically a lot messier than gold. So we're leaning toward gold. Cash still has, 4.5% yield. That's nothing to sneeze at. Our suspicion is that, call it an equal weight portfolio of gold, 10-year notes, cash, probably is a better risk-adjusted bet than anything equity related if we're looking out 6 months.
Okay, Mike, tell us how people can access Invictus Research.
So our regular website is invictus-research.com. You can get all of our products there. We're actually launching a new artificial intelligence enabled product with a new mobile app and a chat that's trained on all of our proprietary research. That can be accessed right now at invictusresearch.ai. And we're going to be rolling out some really substantial improvements to that app over the next 2 weeks. So I really encourage everyone to check that out. And you can also find me at Invictus Macro on Twitter.
Great job, Mike. You could tell you do a video every day.
Thank you, Joel. I appreciate it.
All right, Mike Singleton, Invictus Research, a new guest here on PreMarket Prep. We'll be dialing you up again soon. You made a lot of bold statements here, and I like that based on your research. Thanks, Michael.
Thanks, Joel.
Okay, we are green here, Dennis. Nudging higher
Buy the dip continues to win. It can all change suddenly, but right now, my buy the dip's hat on. My buy the dip hat is on. Let's still dying. Let's go into the Mag 7 and let's preview in depth the big four, because Wednesday's Microsoft, Meta, and Thursday is Apple and Amazon, and that is going to dictate the next course. I think we could continue to be strong into those reports. What happens after is all going to depend on those reports, and I want to start with Meta first, because Meta has actually been a laggard, but in the last couple of days, it's starting to show a lot of life here, and Meta's up another 10 points here again. I mean, when you think about, in the big scheme of things, you can look at Microsoft, it's kind of in the middle of nowhere, and Apple, has bounced back, but kind of in the middle now. Amazon's bounced back, but really when we look at it, Meta's still sitting not that far from 52-week lows, and actually is the only one, I believe, of the Magnificent Seven that actually made a new low, lower than that April. You see what I'm looking at? Than the early April low that none of the other indices took out. So it actually did kiss and make a new low. So I want to get your technical thoughts here, because this is where you're awesome, Joel, is these levels. What are you looking at from the technicals on Meta going into the report?
Man, oh man. I mean, this stock should be a lot higher. And I've seen just a little bit more of a negative news flow regarding Meta. They had the lawsuit, right? Instagram. That's been a little bit of an overhang. Also, I saw some more recent news on it about its AI tools. And so I just think there's been a little bit more negative news flow with this. This has been reflected in the price. I just think they need to
Right.
do okay. I just think if they do okay, I think you could get a Tesla like reaction. Like even
Yeah,
if they don't do okay, I wouldn't want to be short going into it. I don't think they're going to fall on their face. I think it's a low bar right now, and
I
I
think so
think if
too.
they come in at that bar or above that bar, you could be looking at this thing and going 600. Why didn't I buy it at 520? Why didn't I buy it at
Yeah.
530? So that's how
Yeah.
I'm looking at it,
I
technically and
think so
fundamentally.
too. And just diving into a little bit more detail here, let's look at the expected move. And again, if you're newer, and you don't know how to calculate the expected move, all you simply do is go to the closest expiration, which will take May 2nd. And then you just look, I usually just go to the closest strike there. It's kind of easy. And you just add up the calls and the puts. And the expected move on this puppy is about 40, about $45. So that would bring us up near 600 or back down near the lows. But I still
Yeah.
think like we're in this market that if for whatever reason decide to really dip, I think there's underneath demand. I mean, even look to IBM last week, which, fell into the whole like kind of higher bar because the stock went in and it wasn't far from 52-week highs and then sold off. But, last couple of days, IBM's already starting to like kind of find buyers here reemerge again. So I still think, if we dip, probably gets bought. Then I want to go to Microsoft, which the other one reports on Wednesday. Microsoft's a little bit of a different setup because it didn't even come close to making new lows on the recent pullback there. And now you're sitting up here kind of near the highs. So a little bit different story, but you're getting on Microsoft back to where you were in February. And there isn't a lot of stocks that are trading up where they were in February. So Microsoft's relative strength has actually been pretty good. I guess it's March. I guess it's not February, March. But Microsoft's relative strength's been pretty good. What do you see in the chart MSFT?
This has been this peaked of all the Mag 7. This one peaked first. It did. It peaked I believe. We could go back in 2024. Actually in July. This is the one that peaked first. So I don't know. Is this the one that's gonna, be the leader on the way back up? You're finally back to the 50-day moving average. I think it just needs, barring the report, I just think it needs to just hold in here a little bit, and then I think this one has some legs too. Unless they totally, where do they come in on tariffs? From Microsoft.
I
I
think
don't
it's a
know.
safer play. I don't think it's a completely safe play, but when you compare Microsoft to Apple, Microsoft's way less impacted
Oh,
on tariffs than Apple. So let's go to Apple because this is like tariff like ground zero. Apple is tariff ground zero. And if you look, Apple stock has completely moved just with the tariff rhetoric. What is happening? What's the next thing to come here? And Apple obviously got murdered, on Independence Day. And, it's bounced back tremendously since Trump has said the 90-day kick the can down the road. So talk about the setup on Apple here, Joel, because this one is very interesting.
I think they're stuck between a rock and a hard place.
They really are.
Yeah, and I don't think that. What could they come out and say in light of the information that we have right now that would be extremely positive? What could they
I
say?
think it's gonna be the scenarios. I think if I'm Apple, if I'm Tim Cook, I'm probably not just giving flat out guidance, probably outlining scenarios where tariffs land here, here's our guidance, tariffs land here, here's our guidance type deal. I think I'm doing more scenario analysis than that. I think the market will be accepting to that, but this is a stock that is going to continue to be driven maybe the most by, headlines out of the White House. So we've got to watch. We get a deal, and people are talking about a deal with India, deal with Vietnam, deals like that are closer to being done. Deal with China is not close, not even coming not even in the realm of, don't even think about it. It's not even close. But, deal with India sounds kind of imminent. Deal with, Vietnam, which would be great for retail, by the way, sounds kind of imminent. So I don't know. Like Apple sits here and I don't think there's no deal coming, for their Foxconn employees here, so they still got to think about where that's going. So I think they're probably just going to give scenario analysis. What's the expected move? Apple expected move $6.58 plus $4.55. We're looking at, what is that, $12? Did I add that up right? 50 cents,
Yeah.
$11? Yeah, 11, a little over $11. About
I just have to tell you,
5%.
out of all the years covering these stocks and covering earnings and earnings reports and earnings expectations, I think this has to be the biggest, I would not call it a curveball, maybe a screwball. I mean, how in the, what are you swinging at? I mean,
It's
you
tough.
just said
It's tough.
Yeah.
Meta looks a lot easier on the setup. Like, I think if you're trading into the report, and again, I like being long stocks ahead of reports, but I think if you're trading into it, I think Meta, if I had to take any of these through the report, you don't have to take anything through the report. I will take Amazon because it's my long-term portfolio, so I will take that through the report. But as a trader, you don't have to take anything. That's a luxury we have as traders. I kind of like Meta the best through the report. What do you like of those three? And we can do Amazon too quickly. Let's do Amazon, and then let's pick the one you want to take through the report if you had to. So do the technicals on Amazon because it's come back a long ways here too. And Amazon is definitely not tariff-proof either. You think a lot of stuff sells from China over there on Amazon. So, I mean, Amazon is definitely in kind of ground zero with Apple. Kind of might want to group those two together. But take quick technical thoughts on Amazon, and then I'm going to throw you under the bus and make you pick one to take through.
Amazon, I'd rather see a bad report and try and buy the dip. Like, maybe under 180.
I like that. I like that idea.
If it ripped into the report, I don't know what the expected move is. The 50-day moving average is okay. But if I was taking this long into the report, it got to the 205, 206 area, I'd gladly let it go. So that's Apple. I mean, it feels like it's so much of a short that I wouldn't want to short it. I wouldn't want to be long it. This would one I want to be hands off. I think if you want to play one from the long side, I think Meta is just, it hasn't rebounded as much. Yeah, it just, I think there's been other bad news, affecting the stock. Zuck's been in the news a lot. So I think out of all of them, I think this one. Google was last week, right?
Yeah. And Goog, it popped a bit, Joel, and then it kind of just leaked it back. It was almost felt like a nothing burger, really. It was kind of in there. It couldn't even get up near the expected move. So it just kind of stayed within range. So, but you know my story on Google is that I'm just concerned that ChatGPT and all the chatbots are attacking search. And even though Google has a good one as well, I feel like their whole it's 54% of their revenues come from search. That's why I've kind of just been I'm just out on Google for now. I know the valuation's kind of reasonable, but Waymo's not moving the needle anytime soon for that. It's just such a search company. So it's still just really, even though they have a lot of tricks, that search trick is their biggest trick by far. So I'm sticking with you. I think Meta too, but as we get closer, obviously we'll do more setups here. Let's go into 1 minute left. I'll give you my closing thoughts and your closing thoughts here too, Joel. I mean, I think we're just, with the information we currently have, this market still has a buy the dip mentality. So it's hard to break that. There's going to be whipsaw trading action. There's going to be violent moves. I think if you're using stops, it's probably tough right now because you're probably getting stopped out on all these violent moves. It's more of a market where you got to kind of just have a thesis and going with it as opposed to putting your stops too tight, because you put those stops too tight, you get stopped out on everything.
We've got back half of this just big move. I mean, over half. That's at 55.30. We got a little gap fill, little teeny 2-point gap fill here at 55.66 and a quarter. That's only 15 handles away from here, so that's really no big deal. But I think this is going to be the bar for the week here. What are we going to do with this bar? This was a big down day. We started the day on April 2nd at 56.74. Was that a Fed day? Yeah, that might have been a Fed. That was the crazy ass Fed day. Remember that when we rallied up and they completely fell apart?
Yeah.
So how do we? I just don't think we're just going to rip right through this bar right here. I think we can move up incrementally through here. But I don't know. It seems like we've had a nice rally off the low. We got some big earnings later in the week. I think there's going to be this could be the biggest gift of gifts rally ever. The tariffs are not. We don't know what they are. We don't know what to say. We don't know when our next interest rate
It could be.
cut's coming. This could be. When you talk about getting your money back, this could be the get your money back rally. This really could. As opposed to thinking, okay, we're the lowest in for the year, we're at 55.50. Now it's time to load the boat, take us to 5,800. Just not feeling that right now.
I think the low for the year is in. I'll say it again. I think it is.
Okay.
And that's a bold statement. And things can change, and maybe I change that opinion. But at this time, I think we're past like the worries of like 100, and we're past the worries what this is going to continue to escalate. It's been in de-escalation mode. Christian was making that point last week. We're kind of in de-escalation mode. So I think we're kind of past that point. But I do think like you're chasing here. To Joel's point, if you're buying here, you're definitely chasing. We rallied 8% last week. I think though, if we get those, maybe there's a nervousness, maybe there's something said, we get that 3-4% pullback, over the course of a few days or something. I think you're striking. So I think you have a list going. I think you have your shopping list and you're buying on dips. That's where I'm at. I'm not in the camp that we're going back to all-time highs anytime soon, though, either.
You think the low of the year is in? I think the high of the year is in. So why don't we just go back?
I think both could be right. I think both could be right. Range
Chop.
trade, sideways for the win. Remember, I started my year and I said sideways for the win. Maybe we end up sideways.
Quite
Everybody's
sideways.
Like, oh, it's going to
Very
be not that
wide
great a year
sideways.
for stock. People were saying, and we go over time for a minute, but people were saying that, oh, it's not going to be that great of a year for stock. So, I'm only putting on 10, 12%. I think the SP is only going to be up 12% for the year. What freaking market are we in where that's not a good year for stocks? Like, there's so many analysts saying that, oh, it's not going to be that great year. We're thinking 10 or 12%. Holy, take off the bull blinders here, because a 10, 12% year historically is an awesome year for the markets. So we've just been spoiled with these 24, 25% years. I thought we'd be flat on the year. I didn't think we were going to be down 20%, but I also didn't know that, the tariffs were all going to be this crazy like they were. But I do think like the bull blinders were on starting this year, and, we needed this correction, and this was definitely healthy. At least from, I don't like the tariffs, but at least, the market's corrected and it kind of needed it.
Okay. We'll get an analyst look tomorrow. We haven't talked to Ivan Feinseth, so we'll get some bullish commentary tomorrow from Ivan. Great to be back with you guys, getting me caught up on the markets.
Awesome.
That's it for this Monday on Pre-Market Prep.